All right, we are live. Good afternoon, everybody. Today is Thursday, March 23rd, 4:10 p.m. Eastern Time, 2:10 p.m. Mountain Time. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRecipic. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. I got out of my TQQ short, actually on the way up today, so gave back a little bit of profits on that. I did not have it for that crazy little afternoon crash. Traded a few new things today, but didn't keep any of them overnight. Let's go to the videotape. Yeah, oh man, what a crazy day. I'll tell you, one of the craziest things about today is that it was so insane, yet it's still an inside day for the Qs. Qs spent the entire day within yesterday's range. Take a look at the daily charts in a second, but this morning, so the day after a Fed day is often a trend day. It is not necessarily a trend day, but there's a higher probability that today would be a trend day than it would be typically. I don't really consider this to be a trend day. Like when I talk about a trend day, I mean that the market moves in one direction all day, pretty much all day, giving higher highs and higher lows or lower highs and lower lows throughout the day. We didn't really get that. Maybe you could make an argument that the IWM kind of was a trend day, more to the downside. A lot of volatility for sure. Initially, this market was trading very well in the beginning of the day. We had a pretty big gap up. It's always actually, I find this type of gap to be really difficult because the gap is so big that you would expect us to have upside extension because of that gap. But the close was so bad yesterday that really we just gapped right into the equilibrium area from yesterday. So it's a little bit harder, I think, to read that than when you get like a close that's more in equilibrium and then you get a gap in one direction or the other. I actually was really hoping for a gap down this morning because I thought that they were going to buy the market up today, which I know runs a little bit contrary to candlestick analysis off of yesterday's candle, but it goes back to what we were talking about in yesterday's afternoon meeting about bearish, neutral, bullish, and that the market broadly is neutral, but we still have a very mixed message when you're looking at the Qs versus the IWM, at least technically. So I actually really wanted the week close from yesterday to give a down open today, so I could have came in and bought looking for an opening bounce. Instead, we ended up having a gap up this morning, which made things a little bit tricky. I really wanted to see how the market handled things at the beginning of the day, and the first half hour was very boring. Really very boring. About 10 a.m. to 10 a.m., we started to break higher on this intraday chart. The IWM was really not participating until like 10:45. It was actually at 10:45, and I know that's almost highs. It's actually at 10:45 that I thought that the market looked the best that it looked all day, because you had the SPYs trying to go earlier, you had the Qs trying to go earlier, but the IWM did not want to participate and give us any confirmation. And then finally, when I got off the radio at 10:45, we were joking about how the market doesn't want to move until I get off the radio. Literally within like 30 seconds of that happening, the IWM starts to go and the whole market begins to give another leg. Again, you could see Qs here really started going at more like 10 a.m. to 10:10, similar to the SPYs. We never had that IWM confirmation, and I desperately want some mean reversion. The way I want it, ideally, would be IWM catching up a little bit to Qs, but I'm starting to get concerned, and I was starting to get really concerned as the IWM was trading below 170. That eventually the opposite would occur. So I've seen, I wouldn't say I've seen a lot of bear markets over the course of my career. I've seen a lot of like small bear markets. 2022 is probably the worst bear market I've seen over the course of my career. But I've seen some of these deteriorating markets. I've seen, let me rephrase that. I may not have seen a lot of real bear markets over the course of my career, but I've certainly seen my share of market corrections over the course of my career. And a lot of times what happens in those market corrections is you've got some sectors, some stocks that are really trying to hold up as the rest of the market's beginning to fail. And at a certain point, those relatively strong names that are trying to hold up, they just can't handle it anymore. People need to raise cash by selling what has held up best to make up for the fact that they have other holdings that have been not acting well. And eventually everything else begins to deteriorate. And that's certainly a concern that I'm beginning to have right now as I think about this huge difference that we still have between the Qs and the IWM. You know, flipping over to the daily chart right now, again, Qs are an inside day. The Qs closed up. The NASDAQ closed up 1.1% today. The IWM is down 0.4%. So we're still getting, after a couple days this week where the IWM was able to close up more on a percentage basis, we're really still getting an even further divergence overall between the Qs and the IWM. It's going to have to rectify itself, I think, eventually at some point. SPYs are up 0.25%, so SPYs once again kind of continue to have that middle territory between the strength of the NASDAQ and the strength of the IWM. But like I mentioned briefly when Rowan dropped into the VTF and asked some questions, the Qs, I think 44% of the Qs is 5 stocks, if that statistic is accurate. Obviously that statistic adjusts over time. So when you're looking at the Qs holding up as well as they are, it's not really a good broad measure of the stock market. This is a good broad measure of a handful of mega tech companies which are just so massive that they comprise a large percentage of, you know, the S&P and the total market cap of the markets as a whole. Excuse me. But I'm just beginning to become concerned. You know, my thought process has really been like, all right, and the thought process, at least initially, was very correct. Banking crisis is happening. It's not good for banks, especially these regional banks. But your Apples of the world, they've got so much cash on hand. It's going to be a flight to safety to start buying up actually these mega tech companies. And that could not have been more accurate. And you can really see it when you look at the Qs. You can really see it when you look at Apple that has more cash than most countries. Apple just broke out. Apple just had a major breakout above 156.50. It's a major breakout. It's holding above it. It's testing this 160. It's extended. Even with the shooting star candle yesterday, the shooting star candle means that there is, you know, probably greater than a 50% chance of a time or price correction to the ADMA. Today felt like a weak day. I know the NASDAQ still closed decently positive and still was able to hold up and have an inside day. My concern, again, is I'm looking at the other side of the story here, which is the IWM, which represents, you know, probably more of the real economy, if you want to call it that, or, you know, definitely more of the companies that are out there, your small caps, your mid caps. This is giving us an entirely different picture. Obviously, there's a bunch of financial companies and especially regional banks that are incorporated within the IWM that is adding to this weakness, because that's where the crisis, if you want to even call it that, has been located. But you've got this major breakdown in the IWM at 186. We haven't even gotten close to retesting that. We've had a full-on bearish consolidation that's been building out here over the course of a bunch of days. At first, it was easy. Honestly, I think it was easy on like the 13th, the 15th, the 16th to recognize, all right, the Qs are strong and the IWM is extended. I should be buying. And that paid us really well. But the more time you spend here, the more you kind of potentially create this lower high, the higher the probability of a technical breakdown happening. So whereas my original thought process from like that fundamental thesis perspective is that the banking crisis is overblown, that the big banks especially, and I'm still surprised about the relative weakness on the big banks, that they haven't been able to perform better. I mean, you look at this Bank of America chart, it looks awful. It's had a major, you know, bear flag or bearish consolidation technical breakdown today. It really looks bad. You know, I've had the thesis, though, that these banks are eventually going to be okay. We just got to get past, you know, SI and SIVB and a couple of them, you know, blowing up, and CS is now taken care of. and that these things should come out stronger than ever. So my original kind of thesis and thought process is I'm looking at an extended IWM based on a banking crisis that I think is overdone, Qs that are relatively strong. I think what eventually happens is that the Qs go sideways up here, not even really have a major pullback, but they go sideways as the IWM catches up. That's the original thought process. The problem with that is I think the longer it takes for it to happen, the more difficult it actually becomes at least from a technical perspective. And it circles back to the original thought process that I'm trying to get across, which is a lot of the more major market corrections that I've seen over the course of my career start with the market breaking down. Honestly, oftentimes at the IWM, I remember like 2015. 2015 was another situation somewhat similar to today, where you had these bigger tech companies like kind of holding up the S&P and the Qs, but the IWM, the Russell, actually had like a full-on like 30% bear market, and the actual market, the S&P, I think only went down like 10% or something, like barely even into correction territory. But at a certain point, you have the potential, and this is just how markets work, that if this IWM can't recover, if you really start losing this key 170 support area that we're looking at today, which the market shook out that 170 today and kind of closed back up, you eventually might start getting a scenario where the selling in here causes people to raise capital elsewhere. If people have to raise capital elsewhere, where are they doing it? They're doing it in Apple. They're doing it in those mega tech companies that have been safety plays for the time being. That's where everybody's got their cash parked, and you need to raise that cash. You're forced to start to sell Apple, and then instead of my original thought process, which is Qs can begin to go sideways up here, and the IWM catches up as people just figure out what we've already figured out, which is that the banks are going to be just fine and catch that bid. Eventually, if you get continued weakness in some of these names, you can just look at this Bank of America, which I am long, as an example, then you start to actually sell off these NASDAQ stocks. And then if you start to sell off those NASDAQ stocks, then there's nowhere to hide. And correlation increases on the way down, correlation increases into bear markets, and we could have a real problem. So we'll see how it plays out. At the end of the day, the IWM did manage to close above 170. So for the moment, it's a shakeout of a support level. Shakeout of a support level does have a tendency actually to lead to a bigger move in the other direction. So that still could happen. But this is not a very comforting close. It's not like we broke below 170 today and closed at 172.50. We broke below 170 and we closed at 170 quarter. We basically closed at 170. So it's hard to have a lot of conviction in that, and this Russell chart is really not looking good. And at a certain point, to some degree, I think that we have to have this market figure out this difference between the Qs and the Russell. And I know I've said it on a bunch of meetings. I don't recall ever seeing this degree of a technical difference between the Qs and the Russell. And it actually makes the creation of our day-to-day game plan much trickier, because you just don't have confirmation across the board with each index that you're looking at, and that's what you want. You want to be able to look at the SPYs, the Qs, the IWM, maybe even to a degree the Dow, and say, hey, I got the same message from the market here across the board, and I therefore have a higher probability of going long, higher probability of going short, or I could be trying to work this market based off relative strength in two directions at the same time. Which I guess has been a move a little bit, is to be having a long short portfolio if you're in the right stuff. But it's certainly been tricky, and I think it's going to have to resolve itself eventually at some point. So we will see how that plays out. I guess that's all I have from a big picture perspective today. Small picture, few names that were on the list from the morning meeting today. One was GIS that I did not look at I did look at, but I didn't trade. GS off a great looking earnings report. 8150 area was like a very, very clear resistance. I wasn't involved in it. It sounds like a few of you guys were. Trade was about as good as you can expect from General Mills. You had momentum off the open. This pullback is definitely deeper than you want, but never breaks the opening low, creates a wedge. The wedge breaks up, and actually makes new highs before kind of doing nothing for the afternoon, but in some ways holding up better than the market in that sell-off period that happened. So that was an okay trade if anybody caught it. My annoyance, if you will, was on this XPEV today. Had XPEV on the radar off the daily chart for a 1-2-3 play, despite the fact that it's a little bit extended on the daily chart. I like the fact that it's getting above $10 and that this thing has the ability to become more extended, so it was certainly a momentum trade there. Also had LI for 24 kind of on the radar to see if that could give any sort of continuation. Boy, did I think that we were geniuses this morning when this thing took off. $10.10 was the buy trigger. I bought a decent amount of stock pre-market, and then I got like really pretty heavy through this 10.10 when it actually triggered. And I was a little bit nervous about it because the ADMA hadn't caught up to lows yet, and it makes it more of a pure momentum trade if I want to use that as a stop loss. So initially I was using 2 stop losses. I had a core position that I was going to give a little bit more room to, as deep as yesterday's low if I had to, and then a much bigger position that I was trading as a momentum trade through 10.10 versus this low. When the ADMA caught up to the low, I raised my stop to that low for everything. And we got a move in this. I felt supported in this thing by the fact that the Chinese names in general were very relatively strong pre-market. But then off the open, you had like JD sell straight down on that first 5-minute candle. I was like, uh-oh, that's not great. Baba sell straight down on that 5-minute candle. Eventually, these things just needed a digestion period. Or you can even look at NEO, which is more of a direct competitor to XPEV, that gives this down tail, and it's just very sloppy, and it breaks the opening low here at 9:45 before eventually actually improving. So I'm looking at all these Chinese names that are not trading well, and this XPEV, which was not in play for any particular reason, was given a phenomenal momentum move off the open. I was like, oh, let's go. This is very exciting. If I can get, Baba to digest this gap and have the ADMA to catch up, JD to digest this gap and have the ADMA catch up, this XPEV, which is just like a monster here off the open, could really give us a big move. I really thought at a certain point $11 plus would be in the cards for today based on how this thing was moving if we could start getting some support from the other Chinese companies. And then to my dismay, the relative strength that was in this thing just completely disappeared. This name, I think, has the ability to do a little bit of short squeezing. Okay, fine. You get a price correction back down to the ADMA. It's certainly a little bit more of a price correction than I would have liked, somewhat similar to General Mills, which we just looked at. A little bit more of a price correction than you generally would like. I don't use fib retracements, but I do eyeball percentage retracements. And, on something that's this strong of a momentum move, ideally, I really don't want to pull them back more than 50% of that opening move, which will be more of a time correction to enable this ADMA to catch up for a bull flag for continuation. So, all right, price corrects more than you want. Not necessarily the end of the world here. Begins to create this pivot point off the ADMA at 955. Begins to work its way up. At the same time, I'm finally starting around 10 a.m. to get a little bit more confirmation from Alibaba. The ADMA is catching up to that low. JD, the ADMA is catching up to that low. Even like NEO and LI, which were pretty garbage at the beginning of the day, price corrected, now are pivoting and looking like they wanted to actually be able to go as well. This LI breaks, makes new highs and breaks 24, and then this XPEV just can't perform. And then it actually makes a lower high, breaks down, breaks this wedge. And at a certain point here, before I got stopped out, I'm looking at XPEV. I'm like, I can't believe that this was the strongest one off the open, and now I got all these other Chinese names. Like, look at 1035. If you look at 1035, JD is making new highs in the day. Alibaba is basically making new highs in the day. A lot of these things are looking great, and they were weaker to start off. Yet this XPEV is sitting at lows. So obviously something was wrong at that point. Is what it is. Ended up getting stopped out. I was pretty greedy with it. So for me, it actually ended up being kind of a break-even trade because of how greedy I was. Which, I'm fine with that. I'm super, super greedy. Trade fails. I'm break-even. Had this trade really worked out to the expectations I had at a certain point where I'm getting a move to 11 to 1150, it would have been a really, really big payday. So it's just more disappointment than anything about the flip to relative weakness on this stock. So I know a lot of you guys were involved in it with me. Same deal. No one should have lost money in this stock. If you lost money in this stock, you really need to do an assessment of your game plan and your execution, because this was like very easy off the open. Very, like, seriously, very easy off the open. You know, if you're just giving it to lows through 10.10, you got 7-8 cents worth of risk, and it gives a move up to 10.40. You can't allow yourself to execute so poorly, or have a game plan that's so bad that you lose money in it. So again, for myself, I was super greedy and ended up, you know, like roughly break even-ish on the trade when all was said and done, and just kind of a little bit more disappointed than anything else. The other one from the morning meeting today that I was involved in was this tallow that I thought was interesting because it got a buy initiation. So you had this inside day yesterday plus a buy initiation. For sure, I'm a little bit concerned about the market, but I thought that could put it in play. Managed to get a great price off the open. So like 13.41 is the opening low. My price was 13.41. I got kind of lucky with that, but I didn't have a ton of size either. I was pretty light. So sold some stock, I think around 55 cents or so, and then sold some more around 75 cents or so. My next offer was at 14, never got it. Eventually this one failed also and broke that opening low and stopped me out at the opening low. So those were some of the trades there. Into the hecticness of the afternoon, I traded this IWM for a bounce. I definitely started too early. I gotta be careful. It's the second time, I think, in a matter of just over a week that I started a position too early. And when you go in counter trend, I say it all the time, you're better off missing the trade than being too early. Being too early is very dangerous counter trend. It's the second time I've done this in a couple of weeks. I got to be a little bit careful that I'm not getting too happy with myself about the way that I've been trading overall, because I've been trading really well. So I definitely started this one a little bit too early. But I was looking for pretty much the extension move to the downside and then a retest of 170 to see if that holds as resistance on an intraday basis. And I got heaviest near lows around this like 169. Actually, I think I got filled at 168.76 was my best bid. Just looking for the retracement back up. You know, Apple at the same time. I remember buying 158-ish in here, kind of into yesterday's low area. Same deal, looking for the snapback, and then got lucky. You know, really just looking for this move. Liquidated a bunch of my position into the ADMA, and then Janet Yellen made that first comment or whatever. The press release dropped, and the algorithms went nuts, and I got lucky, and then I market sold my position. I got like 171, like 20 on the sale. So a couple lucky fills today, I guess. You know, you buy tallow at the absolute low of this open, get some stock there. You know, obviously you recognize this move in the IWM is big, and it makes sense to liquidate the position in it because it's really not what I was looking for. I was just looking for this retracement trade. But, you know, with the speed in which the market was moving, to be able to get 10 cents off highs in the IWM on this move, that's more luck than skill. So glad for that. Glad for that. And you know, that's pretty much it. Outside of that, just kind of continued position management. I really reduced my JD position today into this up move, also somewhat near highs, which was a little bit probably lucky also. 40.75 to 40.85 area. I took off a bunch of stock in this JD to size down on the position. I think that's it. That's all I got on my side to kind of recap my day a little bit. Happy to take a look at what you guys are looking at. Happy to take a look at any questions that you guys have. First thing I think I'm seeing here is from Dave S. For over a year, the market has been trading in sync at the index level until recently with this Russell to NASDAQ divergence. Well, we've had little divergences, and usually what has happened over the course of the last year plus is that the divergence happens with the Russell, and then the rest of the market follows. Really, that started in November 21. In November 21, you can see on the Russell a false breakout that really sets off the top of the market in a lot of ways. back here, beginning in November, you had this big range that the IWM was in with, let's just call it roughly 230 resistance. You get this huge breakout here up to 245, huge breakdown, and then you have a breakaway gap to the downside that almost creates an island top of action here that's really the top. That led the market lower. If you look at the Qs and the SPYs, they don't top till January. You can see the Qs here basically holding up and kind of really topping out in kind of the beginning of January. I think the SPY put in its absolute high on the first trading day of January 2022. So, you know, you did get that divergence back then, and you've had a bunch of smaller divergences throughout 2022. And the rule, very consistently for over a year, is the IWM goes, the rest of the market follows. The IWM breaks down, you know, the Qs follow, the SPYs follow, everything else follows, which is what is making this current market environment so interesting, because this is for sure the most extreme that divergences actually becomes. The IWM popping after hours right now? Yeah, Russell's popping back up a little bit after hours. This is the most extreme by far that divergence has been. And obviously this is a unique circumstance from the divergences that were smaller that we saw over the course of the last year plus, because it's brought on by a specific news event with this banking crisis, which has actually given me the thesis that I had, which counter to the smaller divergences that we saw over the course of the last year and a half, where the IWM leads in and the market follows. I was actually thinking that that this would be potentially the opposite. Sorry, just give me 1 second. Come on. Yeah, actually, sorry, someone's at my door. I'm just trying to look at this Ring doorbell thing I have to see who's there. Alright, whatever, it's not working. We're talking about this divergence and how it gets resolved. Yeah, so the specifics of what's caused this divergence is giving me the thesis that it could be the opposite of what we've seen over the course of the last year and a half, which that's always dangerous when you say to yourself this time is going to be different. But I think that the situation that's creating it is different, and that's why I think this time could be different. But like I said, to start off the meeting, I'm just really concerned if we start getting below 170 that I'm wrong, and that eventually this IWM starts pulling down the Qs, which is what we've seen consistently in the past. So anyway, let me read the rest of your question. Would this indicate that the market is ready to start once again trading off of individual stock sector quality instead of macro data, or am I reading into the tea leaves too much into that theory? I mean, I always love paying attention to relative strength and relative weakness. I think it's one of the most important layers of probability that's out there. You want to know what's going on. My concern, though, actually, is that the opposite of what you're describing here will begin to happen if the bear case plays out. If the IWM starts losing 170 and it starts creating forced selling in the mega cap tech companies, the correlations actually begin to increase, which is similar to what we saw in the deeper depths of bear market action in 2022, where in the heavier selling situations, they just sold everything. The selling becomes indiscriminate. In bear markets, correlations increase. So that's actually my concern. Up until now, the last week or two here, for sure, it's been all about recognizing individual stocks. It's been a stock picker's market, if you want to call it that. Individual stocks, individual sectors, long relative strength, short relative weakness has been great. So that's my thoughts. Shane here giving us the top holdings of the Qs. Yeah, Apple, Microsoft, Amazon, Nvidia representing 10, 20, 30, yeah, like, you know, 30 to 40%, just eyeballing it, of the Qs. From Pam, what's a good strategy or thought process for buying stocks that are extended on the daily for an intraday trade? A lot of these have really moved recently. And I remember you called out earlier this week when Google was relatively strong and had a big move, even though it was extended. Degrees of extension are what are key, I think, and understanding the stock or sector or index that you're looking at is also key, because certain stocks, sectors, indices can become more extended than others. So when you're looking at the counter trend trade, I know people were looking at like AMD and NVIDIA on the short side today for counter trend trades, and I actually think a few of you guys were able to do well with that. I just thought that was a really difficult trade, because AMD and NVIDIA, they're the type of stock that has the capacity to become much more extended than they even are right now. I know exactly what day you're talking about. You're talking about this day on the 21st. When Google gave this big move. I remember that morning actually not liking Google. I didn't like Google this morning because I felt it was too extended for a new buy. You had this really big 4-day move, 1 day of rest. ADMA has not caught up yet. I do not typically like the idea of buying Google on the 21st. What happened there that led to us, that ended up being the trade of the day, even though I didn't like it. And this is why, by the way, we do all of our research in the morning meeting, and I think that for the morning meeting, I think that that's extremely important, because it's way easier and better to do research when the market's not open and your P&L's not moving. You can do it much more objectively. And I do find that my best trades and best P&L stem from the work that I do before the market opens and not the work that I do when the market is open. But obviously when the market's open, what you're doing is when you're executing. Really, the trading day, I think, is primarily about executing the research that you did before the market opened, while recognizing that you're updating the information in your brain and changes can actually occur. But I love the fact that the stuff I do in the morning, I'm not influenced by emotion, P&L, anything like that. I'm able to view the market much more objectively. I think that's why my trades based on my morning research tend to be much better than my trades that I kind of find and do intraday. And I've learned that about myself. So I'm very cautious and very hesitant generally to do much trading that was outside of the purview of the research and game plan that I created for myself in the morning. With that said, I don't like Google that day because of the stuff that you're describing. It's like a little bit too extended here. It just had 4 big days up in a row. I don't want to buy it that day. It was based on an intraday signal that we had. I remember you could probably review the afternoon meeting from this day to look at the charts and everything specifically on YouTube. But we had that pullback that occurred, I don't remember exactly what time, somewhere between 9:45 and 10 a.m. The Qs broke lows, they ended up creating that tail. Amazon broke lows, it created that tail. Google did not break lows, it didn't even tail back down. And may have also had an upgrade that day, which I pay attention to the upgrades for sure. But when I do my research and I'm looking at upgrades and downgrades, it's always within the context of what the technicals look like. I'm trying to remember this other company that reported earnings last night that I didn't like the daily technicals on. I don't care if you got upgrade or you had an earnings report that looked good or whatever. If I don't like the technicals, I want to combine them. So I'm sure that when I did my research on the 21st in the morning, and I saw that Google got upgraded, I said I don't have an interest in buying or adding to Google today. It's too extended on the daily. I don't care that it got upgraded. That's how my thought process typically would be. And then again, it was just the intraday price action that kind of created that signal that said, oh wow, actually we probably can buy Google and get involved there. So yeah, I would say very generally, Pam, because I think this is the direct answer to your question, I don't like buying stocks if they're too extended on the daily chart. Too extended is going to be very relative to the stock, sector, or index that you're looking at. And again, you could also go back to XPEV from today. Don't normally love the idea of buying a $10 stock at $10.10 with the ADMA at 9.30. That's a huge extension difference. But I know the stock really well. I know that it can short squeeze, and I know that there have been times in the past, again, I referenced this in the morning meeting back here in December, XPEV was able to get $3.50 extended. So I know that this thing just is going and breaking out, that it could give me a big, big squeeze. And that's why I also said this is very specifically a momentum trade. So I, again, to circle back and answer your question, generally do not like buying stocks that are extended on a daily. Let's just make that like kind of the very general rule. But I also will take it a little bit on a case-by-case basis based on the stock that I'm dealing with and if there's any potential news. From Kyle, was just wondering, with a name like General Mills, even though it had great earnings, are names like this, consumer staples, still better off having a less greedy game plans? Personally, I was pretty greedy with this. Still made money. Just curious about the game planning in names like this for going forward. Yeah, so you've got less reward potential in a consumer staple. They got smaller ranges. It's usually why I don't like trading them. But I think if I am going to trade it, I'm going to game plan it the same. Because if you think about what we do with like a trailing strategy for reward maximization as an example, just because it's a consumer staple and it's going to have a smaller average range doesn't mean that it can't go into a nice uptrend and give continuation over a multi-day trade. So, I certainly want to recognize that the idea of General Mills today going from 81.50 to 91.50 is like, let's just take General Mills and take AMD, which is like roughly a similar priced stock. If AMD went from 81 to 91 in a day, I wouldn't be like overly surprised. But if General Mills went from 81 to 91 in a day, I'd be like, what is going on with this? They make cereal. So that for me, though, that's just more of a reason to probably not trade it. If I was going to trade it, I'm probably trading it roughly the same. Because it doesn't mean that it can't get to 91 over the course of a couple of weeks if I'm swinging it and I got a good close. So, hope that helps. From Rex. When comparing relatively strong or weak stocks, sometimes stocks don't go up with the market or other stocks in the same sector. How do we determine it's lagging or weak? Sometimes those lagging stocks will weak up and then become relatively strong stock in the market. Is buying lagging stocks more dangerous than buying relatively strong stocks that has already shown strength? And you have a second question. Let me start with the second question. So, relative strength and relative weakness is an important layer of probability that I like to pay attention to, but it can also be tricky because of the concept of mean reversion. So when you're looking at mean reversion, and this is what pairs trading is based off of, mean reversion actually says the opposite. It says that the outperforming stock and the underperforming stock should mean revert. The only way that will happen will be that the underperforming stock becomes stronger than the outperforming stock. So, relative strength and relative weakness is certainly not the end-all be-all by any means, but I think it's an important layer of probability. And like in the Google example that we just referenced, that trade from a couple days ago, recognizing that small time frame strength was extremely important. Like everything else, you need to view this within the context of other things. So it's not unusual, because we talk about like, oh, buy the relatively strong stock, but sometimes we also talk about, ooh, I wonder if this can play catch up to everything else, right? We say that too. And we're talking about catch up playing, that's more mean reversion. Like, oh, this should mean revert back up to catch up. So it's not a perfectly straightforward concept all the time, and what you're describing can happen. I don't have like a good direct answer for you on this one. I feel like you need to pay attention to everything within its context. That would probably be my not so great general answer. Is that you got to pay attention to relative strength and relative weakness, and what's lagging and what's leading in the context of kind of everything else. Is there a specific reason why it's lagging? I guess I try to keep it simpler. For the most part, if I'm looking at all the different banks and Wells Fargo's weak and JP Morgan's strong at this moment, I'm probably going to want to be long JP Morgan. Maybe that mean reversion eventually occurs, but it could also occur on a bigger time frame than what I'm actually looking at on my 5-minute chart right now when I'm thinking about executing JP Morgan long. So, I don't love my answer for you on this one, to be honest. It's annoying me. but that's the best I got for you. Seeing Eddie in the YouTube saying Schwab also awful. Yeah, you know, really interesting. I think the headline from the CEO of Schwab today, or yesterday, I think it was today, was something like, if every depositor wanted all their money back today, we have enough money on hand to be able to do it. Which, it's kind of a crazy headline. I couldn't help but ask myself why. Why don't you do more with your cash, man? But yeah, despite that headline, stock is awful. And the other headline that was really interesting that came out yesterday was that SoFi headline, when SoFi came out and said that they can have FDIC insurance up to $2 million, and we were all scratching their head like, how the hell did they pull that off? And I didn't read that article. I really should go back and do some more research on it, but somehow they're making a deal with other banks to spread out those deposits, I guess, somehow, to increase the FDIC insurance. Sounds almost shady to me. And if they're doing it, why isn't everybody doing it? I've not done enough research on it. But it's interesting to see, you know, a Schwab CEO come out and say that they, you know, are solvent if every single person wants to take their money out. And SoFi saying we found a way to be able to, you know, give FDIC insurance up to $2 million. It's really interesting. I also still go back to the fact that almost all these banks, when you're talking about FDIC insurance, which is up to $250,000, which I do personally think should be increased. If you look at SIVB, Silicon Valley Bank, what were 3% of the deposits under $250,000? What percentage of that is that at all the other banks? You know, banks that are more consumer focused have much larger percentage that is within the $250,000 FDIC insurance, which also helps create safety. Depositing your cash into multiple banks. But SoFi is a bank itself. Robinhood's not a bank, which I think is a very interesting difference. Yeah, the Schwab daily chart, similar to Bank of America, does not look good. Bearish consolidation breakdown beneath 54 today. I don't like, so I've been staying away from Schwab, which I don't really consider Schwab to be a regional bank. Maybe it is. Maybe it's, I don't know if it's in the KRE or not. But broadly, I've been staying away from any bank that's not Bank of America, JP Morgan, etc. for my trading, because I just don't trust these FRCs of the world right now. Rivian and Lucid were leaders today. Yeah, I mean, tech growth in general was able to act pretty strong. Rivian held in pretty well. Lucid held in pretty well. Insane to me that the market thinks that Lucid is safer than JP Morgan. What are your thoughts on multiple time frame analysis? This is from Mike H. Like using 2, 5, and 15 for trade confirmations. Multiple trade analysis is extremely important, and is, you know, I don't think that you can look at one time frame in a vacuum and be a successful trader. I don't use a 2-minute chart. I hate 2-minute charts. And I think that much more important than 2, 5, and 15 is getting a daily chart in there for your multiple time frame analysis. You can't, if you're trading a stock, and I don't care if you're a day trader, I don't care if you're a scalper, I don't care if you never go home with overnights. If you are trading without doing an analysis of the daily chart of the stock that you're trading with blinders on. You're missing the biggest piece of the puzzle, even if you're a day trader, by not looking at daily charts. Everything starts from the daily chart, as far as I'm concerned. And then you go down to your 5, 15, maybe your hourly for execution and for multiple time frame analysis, for confirmation. But you take the 2-minute chart, throw it in the garbage, because that's where it belongs. Same thing with your 1-minute charts. If the 2-minute chart belongs in the garbage, which means that if you ever need it, you could jump into the garbage can and pick it back out. Take your 1-minute chart and throw it in the furnace. total waste. Anything else, guys? Looks like we got through it all. From Zach. Do you change your game plan at all when you have a bit more cushion from short-term day trades and give a bit more room? Or is your plan always a hard number when holding for over a week? So now you're asking about swings, despite Fed day and news. So I do not change the game plan on a trade that I have after I'm already in it. I have a, I was comfortable with this game plan and comfortable with my risk when I entered the trade. I'm not going to deviate from that. Doesn't matter what the circumstance is. Doesn't matter if it's an overnight trade or anything. Don't deviate from the game plan that you originally created. 1. 2 is when you're looking at your P&L cushion. Remember what I think we said in yesterday's afternoon meeting. The P&L to the top of your screen can be very deceptive. What your P&L says on the top of your screen is not your P&L. Your P&L is your worst case scenario P&L. If you're up $10,000 right now, but at every single position you're in, and I don't care if you got longs and shorts on, trust me, your longs will go down and your shorts will go up. If your P&L says that you're up $10,000 and if every single position you're in stops you out and then you're only up $5,000, you're not up $10,000, you're up $5,000. I don't care that your screen says you're up $10,000. It's an illusion. What matters always is the worst case scenario. So that's 1. That's actually 2. The only thing that I might do a little bit differently, that I might adjust, is new trades that I put on based on trades that I already have on. I do that in both ways. I don't necessarily, it seems like your question is implying like if you're doing really well to ramp it up. Yes and no. If I've got a lot of long trades on and all those long trades are doing really, really well and they're giving me a really good profit cushion, I might actually be more defensive on new long positions because I already have so many long positions on. If the market rolls over, I got to recognize what I was just saying about worst case scenarios. And then actually the opposite might be true on shorts. If you remember, we went over in detail the other day how I shorted the Qs. I guess that was just yesterday. How I kind of was able to short the Qs at highs and how my sizing worked and how I didn't have a direct stop loss in. I'm able to do that with more risk than I probably would otherwise because of the P&L that the longs are giving. So I almost feel like your question about P&L cushion there, I'm almost giving the opposite answer of probably what you would expect. So I hope that helps. From Edward, if you don't use the daily or don't like extended daily charts, what do you use and why don't you like extended dailies? Oh, I do use, well, that's what I was just saying, is that I 10,000% use the daily. You have to use the daily. The daily is the most, I think the daily chart's the most important chart. It's the most important time frame. You can't trade without a purview to your daily chart. Everything is based off the daily. The daily tells me what that I want to be involved in, and the daily tells me what I want to be involved in, and the 5 and 15 tell me how I want to be involved in it. So, yeah. So if I don't like extended daily charts, it means I just don't trade the stock. If the stock is too extended, I'm either not going to trade it at all, or at a certain degree of extension, I may take the other side, and I'll harken back to the Microsoft chart for that. I love Microsoft. Microsoft is my favorite company. It's my favorite company in the market. I love Satya Nadella. I love everything that this company is doing, and it's been ever since this guy became CEO. A big fan of him as a CEO. Big fan of the company as a whole. I think they're incredible. And I have spent a lot of the last 8 or 9 years now long Microsoft. There's probably been more trading days there definitely has been. There's been more, by far, more trading days where I've been long Microsoft than I've been flat the stock over the course of the last 8 or 9 years. And it's my favorite company in the world. I shorted it on the 17th. Went short Microsoft. So almost I need to go to confession or something like that with like a priest. I committed a sin. I shorted Microsoft. Can you believe it? But I like money. So you know, day 4 here, if I'm not already long Microsoft, I'm not buying it. Or, you know, if it's super extended on a daily chart, I'm just not buying it. The extension tells me I just don't want to be involved in this. I've got no advantage. There's no good risk reward on me trading this name here. And then a certain degree of extension, it actually begins to go even in the opposite direction. I still love Microsoft, but you're telling me Microsoft is having a day 5 now, and is trading at 183.30 with the ADMA at 160. Sorry, not 183. 283.30 at highs with the ADMA at 265 at that time. It's just a massive, massive move. Or a bunch of us, Pat, myself, a few other people, we kind of started shorting this thing near that high, and I was able to make a few dollars for myself. And it was just a day trade. I probably could have had a longer hold on it. You know, could have got this pullback to 270, which makes a lot of logical sense, just based on the degree of extension, the doji that came in, the move that happened. You know, back to the ADMA. So yeah, but. Your second question here, why don't I like extended daily charts, is because if you are going long stock after a big move, you inherently have a significantly worse risk reward and probability of success on that trade. If you are going short a stock after a big move, and again, extension is relative, big move is relative. You know, if it's a little bit extended, you know, like again, I was long XPEV today, or you know, we went long Google on this day. You know, Google was extended here, but it wasn't so extended that it can't continue. You know, I might still take the trade, even though, again, I do inherently have a worse risk-reward and lower probability of success. But at a certain degree of extension, your probability of success and your risk-reward just becomes so poor that it's not worth being involved in it. It's too extended to buy, but it's not extended enough to short. And I would say, like back to Microsoft at like 270 on this day. I don't care. And look, I don't care. I don't care that Microsoft went from 270 to 283 before it topped out. I will tell you all day that buying Microsoft at 270 on this day is a bad idea. It's a bad idea. Yeah, sure, it went up $13. I don't care. Because for every time it goes up $13 from this spot, it's pulling back $8 from that spot. It just doesn't leave me in a really good spot to put the position on. And all that matters at the end of the day is risk reward and probability of success. Else have anything for today?